Google had some great results last night, but managed to overshadow them with some terrible corporate governance news. They announced a stock split that creates an entirely new class of shares that really doesn't help anyone but a couple of guys. Rob, what's behind this crazy decision?
What they're doing is they want to keep control. It's been 8 years since they've been public, but they like to have all the toys. So.
And the top three guys there, the two founders and Eric Schmidt, the first major CEO, have how much?
They have 66% of the votes. They have about 25% of the stock, but 66% of the votes. And what this is going to do is going to accentuate that. It'll well,
entrenches them basically. Well, I mean, you made the point. I mean, this is essentially a big race to the bottom in Silicon Valley. Google sort of led the way.
They kicked it off when they initially went public. They had two classes of stock, so that the insiders could keep control no matter what.
And that was sort of copycat from a lot of the big media.
Yeah, and they had some reasons. They said, well, we can do this because we're investing for the long term. We're not like the typical Wall Street quarter by quarter thing.
And there's a degree of truth to that. I mean, there's nothing wrong necessarily with a pretty new firm as Google was, making sure that if it goes public early to raise enough money, that it actually has the ability to keep some control.
It does prevent sort of it's a takeover defense. As we say in the early days when you're trying to build a company.
Yeah, for a period of time, there's nothing necessarily wrong.
But now,
with it, right?
I mean, is anyone really going to take over Google for $200 million?
Right. Well, and the point is also that so Google kind of pioneered this to a certain extent in Silicon Valley years ago. Now Facebook has come along, Zynga has come along. They've
shown that investors don't really care about a vote. You can pretty much do whatever you want. Investors they want the hottest tech company. And so Google looked at them and said, okay, let's do this, let's copy them. And so what they did is they introduced, so they've got the non-voting stock. And
before the two classes they had were, one was a super voting class of stock, the other one was sort of just a regular voting stock. Now they have this third, which is completely non-voting.
It's like, the aristocrats, the middle class, and the peons, that type of thing. And the problem is that they're going to use this non-voting stock. They can use it for acquisitions, they can use it for employee compensation.
Comp.
And what that means is that, we've seen this story before when you get companies after like 30, 40 years, like a News Corp, for example. What's good for Rupert Murdoch isn't necessarily good for shareholders.
The interests start to
diverge as Google becomes a more normal company and as insiders start to sell.
But I mean, what's the argument for needing this? I mean, you looked at this as well, right? That they'd have to do some pretty big mergers to actually even get their.
They were pretty well insulated already.
They would have to basically double stock to lose control.
So you're talking about hundreds of millions of dollars before they would even come close to losing
And don't forget, what is
control?
control? I mean, Steve Jobs had what, like 6% of stock, 5% of the stock, and he was a dictator. And he could have done whatever he wanted, and shareholders would have gone perfectly along with that.
So there's a little bit of paranoia here.
Yeah, if you perform well, that shouldn't be a problem.
Right. All right. Well, we'll leave it there, and we'll be back with more Breaking Views next week.